This Week in Economics on the 21st of January 2018 from WBRN Radio in Boston and on the Bostonred Network. And I perhaps should add our network of outlets, including iHeartRadio, Stitcher, YouTube, and various others. Seiner, I don't want to forget them. The new wireless activated speaker system, Echo from Amazon. They're all there. Spreaker. These fine outlets so you can hear us throughout the world. We'll start here with the shutdown in Washington. This is from the New York Times. We were looking for some information here. We'll go to the Beige Book. That is an analysis of the various Federal Reserve districts throughout the U.S. This is The Longer It Lasts, the More the Shutdown Could Hurt the Economy by Patrick Coyne and Jim Tinkersley. Anyway, let me get to this. We'll look at the last one. The shutdown could also prevent federal agencies from releasing economic data, which we thrive on here, and traders relying on it to make market decisions every day. No doubt, economic activity typically snaps back soon after a shutdown ends, but not before the partial stoppage damages growth. Now, 16-day shutdown here. This is our reference point. Now, you have to remember the economy is a little different in 2018 than in 2013. We had started to come out of a depression of 2008, and there were lingering after effects there with the economy. Now, this is some of what has happened. May have cost the economy $20 billion in input, cutting 0.5% off the animized growth, economic growth rate in Q4. Now, this is Q1, according to securities rating firm. Let me just refocus here. Moody's. The shutdown peaked. 850,000 federal workers were furloughed for a total of 6.6 million workdays. Paying them for those days not worked cost $2 billion. Private sector work was also affected. The 2013 shutdown cut job creation in the sector by 120,000 over 2 weeks. Now, the Council of Economic Advisors estimate that in an analysis conducted immediately afterwards, a range of indicators show that sentiment and job creation, consumption, and some elements of production grew more slowly in the first half of October than in the previous months. The report concluded, as a whole, the shutdown cost the economy at least 1/10% of a growth per week, probably much more. The Congressional Research Service surmised in a report in 2014. A separate report from the Bureau of Economic Analysis, which we rely upon here very much, and a numbers man. A part of a larger analysis by the Congressional Research Service found lost hours worked by federal workers over the 2-week shutdown in 2013 accounted for 0.3% drop in a quarterly growth by themselves. Now, this is from the President Council here. The T.J. Trump economic advisor estimates every week of furloughed federal workers will reduce annual economic growth by 0.2%. Now it dropped, another shutdown would trim at least 6.5 billion a week from the nation's economic output. As economists at Standards & Poor's. A shutdown affects not only Washington and its workers, but also ripple effects across sectors throughout the country, from shopping malls to national parks, from contractors to hotels. That is from Biff and Vobino, the chief United States economist at Standards & Poor's. Job recruiters worry that a shutdown also slows hiring. We face a very real risk of national hiring hesitation, with recruiters placing plans on hold and job movers opting to sit tight for the foreseeable future. That is from Doug Moreau, the founder of global job search engine at Zuna. And then there are the consequences for Wall Street. The near month-long shutdown in this is 1995-1996 coincided with a 5% drop in stock prices. Certainly, the market has been proven quite resilient. That's Nancy Van Houten, a senior economist at Oxford Economics. I think that a brief shutdown would bother the market. Don't think it would bother the market. Excuse me, but a longer one would. We are starting at Cranston Analytics to start looking at this in terms of segments: 7 days, 14 days, and perhaps even 21 days. Now, I think you'll get some general agreement that when we go past the 2-week mark, if in fact that happens, then the consequences change. Now, remember, we're in a global economy, and that in itself has a much more tighter effect, and we'll see how it turns out. While the federal government shutdown only risks delayed payments for discretionary spending categories, an analyst at Morgan Stanley, a Treasury default driven by debt ceiling would be a catastrophe for the U.S. Treasury market and for macro markets in general. And that was the end of that segment. Look at one more thing, and we'll go to the Beige book very, very quickly here. I'm not certain what we'll get out of this. This was economic activity during the government shutdown and debt brakemanship, debt limit brakemanship. This is in 2013, and I'm not certain when we're doing this. The government shutdown and brakemanship had a substantial negative effect on the economy. The shutdown directly affected the economy, withdrawing government services for a 16-day period. Not only had direct impact, but also had a range of indirect impacts. Now, the travel business was hurting, the closure of national parks, business in oil, gas, etc. Other industries were hurt by cessation of permits. Now, a lot of people don't think about this, but there is a permitting process for oil and gas drilling. Housing industry was hurt by cessation of IRS verification for mortgage applications. Small businesses were hurt. Loan guarantees, in addition, reduced consumer confidence and increased uncertainty associated with the shutdown, but also brakemanship over debt limit affected consumer spending. Now, this is one of the things we look at here. Amortized growth, GDP in fourth quarter, by anywhere from 0.2 percentage points. And we talked about this to 0.6 estimated by Standards & Poor's, with intermediary estimates of 2% and 5% from macroeconomic advisors, our friends in St. Louis. and Goldman Sachs, respectively. Most private sector analysis are based upon models that predict the impact of the shutdown based on reduction in government services over that period. Very few of them are based on actual analysis of economic performance during the period of shutdown. Very few take into account secondary effects of private sector cessation on government services or the effect on confidence and uncertainties associated with both the shutdown and debt limit brakemanship. But we know that these effects can be larger. For example, debt limit brakemanship in the summer of 2011 had an adverse economic impact, even though it was not accompanied by a shutdown, nor it led to an actual default. And remember, we covered that, and yes, there was problems there. Let me get to this. The report attempts to, the impact of the shutdown, default, brakemanship, measured by 8 daily and weekly economic indicators. The weekly economic index are consistent with 2.2% reduction in amortized GMP and rates in Q4, reduction of 120,000 private jobs in the first 2 weeks there. Now, these are some of the things that happened, and we'll append this, won't go on with this rundown, but we just wanted you to see what the actual impact was. Now, let us go. And now this is the Wall Street Present. This is from Reuters. The S&P 500 and NASDAQ here. Several people, Naki, Philip Morris, rose 1.5 and 4.8 percentage in upbeat analyst expectation, helping to boost the S&P 500. And on the other end of it was IBM and American Express. The Dow Jones Industrial Averages rose to 53.9 or 0.21% there to close at 2607.71. It gained 12.27 points there. The Dow rose 1.4% and added with the NASDAQ. 9 of the 11 S&P sectors were high, led by 1.1 gain in the consumer staples index, etc. And a 0.9% in consumer discretionary stocks. Disappointing full-year forecast from IBM. We want to talk about this. I think we covered it last time around a period just to set this up so we can move on. We'll also talk about China and where China is. Retail sales in the UK were disappointing. Many shoppers shifted in the UK. We'll get to this in our roundup here. One other item before we go. Amazon has raised monthly prime rates. Some people do, in fact, pay by the month for Prime. Here it's the annual cost is $99. Their Prime subscriptions tend to do more shopping with the subscribers with the company services available in 16 countries. Thought we'd throw this in real quickly here. About a quarter of the people opt for monthly payments, and they will rise from $5.49 to $6.49 here, and $2 to the plans. Now, Netflix has also raised their basic rates, and their rates here for students, etc., is about half price. I think it'll remain the same for Amazon. So we can move past Amazon here and back to the BBC. We'll go now to the beige book. We want to look at it. We have what we wish to have here. Wrong report. We'll get it in just a second here. The beige book itself. Here we go. Now, the beige book, a little bit of a summary here. We've done this many times, is the Federal Reserve's publication of current economic conditions across 12 Federal Reserve districts, characterize economic conditions, prospects based on a variety of quantitative information given directly from direct sources. Now we'll do several of these. We'll do the first district is in Boston. We'll do New York, and then we'll start to skip around a little bit here. And I guess thought we'd be able to jump, but we're not going to be able to jump. Anyway, Reserve districts indicate the economy continues to expand from late November through the end of the year, with 11 districts reporting modest to moderate gains, and Dallas reporting a robust increase. The outlook for 2018 remains optimistic from a majority of contacts throughout the country. Most districts reported that non-auto retail sales expanded since the last report, and that auto sales were mixed. Some retailers highlighted the holiday sales were higher than expected. Residential real estate activity remained constrained across the country. Most districts reported little growth in home sales due to limited housing inventory. Non-residential activity continues to experience slight growth. Most manufacturers reported modest growth in business conditions, and reports indicated that some manufacturers increased capital expenditures over the reporting period. Most reporting districts noted a continual growth in transportation activity. Loan volume in many was steady. Amongst districts reporting, agriculture conditions were mixed, and energy contracts described as slight upticks. Employment and wages. On balance, employment continues to grow at a modest pace. Since the last report, several districts noted elevated demand for manufacturing, construction, labor. Most districts said that wages were increased at a modest price. A few districts observed that firms were raising wages in a broader range of industries and positions since the last report. Prices. Most districts reported modest price growth, which in itself is a very good sign in those districts. Now we'll just do the highlights on these districts. Starting with Boston, we hope. Economic conditions expanded at a modest pace in 2017. The majority of contacts at manufacturing, retail, software, information technology firms reported revenue increase, and some saw flat or declining revenue. Employers cite tight labor markets as a constraint to expansion. In New York, economic activity continued to expand at a modest rate, while the labor market has remained tight. Input pricing has increased at a somewhat faster pace, while selling prices continue to rise modestly. The housing market and commercial real estate market has been mixed, but generally steady overall. In Philadelphia, continues to grow there, modest pace there. For manufacturing, non-financial services, non-auto retail sales improved to a modest pace. Construction and real estate sectors changed little. On balance, in Cleveland, the economy continues to expand at a modest pace. Cleveland used to be one of the areas that we did not get this wage pressures coming primarily from workers in low and middle skilled jobs. Retailers report higher than expected revenue for the early part of the holiday season. The home builders saw little evidence of seasonal downturn in the housing market. In Richmond, Virginia, the economy grew at a modest pace. Robust growth was reported by trucking and tourism firms. Retailers generally reported better than expected holiday sales. Meanwhile, commercial real estate activity, commercial lending improved modestly. Labor market tightness, again, there it'll be interesting to see how the Richmond district is affected by the shutdown. In Atlanta, the labor market remains tight. Wages increased, were stable. Non-labor impact costs picked up. Retailers were optimistic when reporting on holiday sales. Home sales were mixed. Commercial real estate contracts continue to indicate improved demand. Manufacturers had an increase in orders. In Kansas City, economic activity, employment expanded modest rate in late November and December. Retail sales increased sharply. Manufacturing energy sectors expanded further, and capital spending plans were positive. In Minneapolis, economic activity grew at a modest rate. All hourly employment levels, employment levels dropped. Hiring demands appeared to remain strong. District indicated that a solid 2017 would continue with upbeat expectations for the year to come. Holiday retail sales were strong, but winter tourism got off to an uneven start. Commercial construction increased. Home building was mixed, but residential sales were up. On to Dallas. Economic activity grew in a robust pace. The manufacturing sector remained a bright spot, although growth acceleration in other areas as well. Employment picked up. Wages and prices pressures remained elevated. Labor shortages, we hear that word cropping in here, with several reports that difficulty hiring was impeding growth to some extent. In San Francisco, continues to expand at a modest pace. Sales of retail goods picked up. Noticeably, growth in consumer and business services remained strong. Conditions in manufacturing remained strong. Activities in residential real estate market remained robust. Lending grew at a modest pace in San Francisco. In Chicago, activity picked up to a modest pace. Employment, consumer spending, and manufacturing increased modestly. Construction and real estate activity rose slightly. A little different in this district here. Business spending was unchanged. Wages increased modestly. Prices rose slightly. Financial conditions improved some. Crop and dairy farmers come in here to facing challenging conditions. In St. Louis, economic conditions continue to improve at a modest rate. In positive news, retailers reported holiday sales were generally upbeat. Auto dealers continued to report mixed sales results. Agriculture conditions remain weak. This is in St. Louis. So the ag markets have not done the best out there. Business activity, this is a summary here. Most retailers, manufacturing, etc., technology, IT sectors saw revenue increase, although a minority reported flat to slight declines in the year. Amongst retailers, online sales performed better than in-service stores. Retail revenue increased amongst software and IT services was strong, ranging from 10% to 20% year over year. Commercial real estate markets continued much as in the last report, with residential prices increasing in general, while sales were mixed. Labor markets continue to be tight. Contacts in many sectors cited tight labor markets. We talked about that. Local retailers said 2018 meant raises would be in the order of 2.5 to 3%. Restaurants said labor shortages continue to constrain business. Only one manufacturing contact reported a significant increase in employment, and many say that the labor market was very tight. One manufacturer was 3 months behind in schedule trying to hire workers for a new plant. Another industrial firm had 20 on-field openings in a plant with 100 workers. In other words, that's 1/5. Said they were making it up with a significant overtime. Now, this is something that is not understood by many people. Overtime in itself does not cost the firm extra money in the sense that the workers are already on the scene. So if a worker is there for an additional 8 hours, yes, that is cost, but at the same time, it is less than hiring a new worker. I think that's the point we're trying to make. Let's see. Another industry contact said when a worker leaves, they actually end up paying the replacement to 10% more than the departing worker. Software and IT services contacts have kept their headcount close to flat in recent months, although plans to increase staffing up to 10% in 2018. The contact noted that shortages for technical roles such as engineers were getting worse. No doubt. Price movements were somewhat mixed. Retailers reported prices remain steady, and but most appeared to be new environments and appeared. Let me just a second here. My program is getting in my way. Let's see. Won't spend a lot of time on this. Employment and wages here, software industry. These contacts noted the shortage for technical roles. Okay, we already got that. We were moving down to prices. Manufacturing-related services. Of the 9 firms contacted this quarter, 5 reported higher sales versus year-over-year period. 2 reported sales and flat sales, and 2 lower sales. Now let's get to the software and technology services. Tech contacts in the first district are doing well on the whole, with strong demand growth between 10 and 20%. And we are doing the here. Let's see. The first district. This is Boston, or it should be Boston. Yeah, it is the Boston Fed. Anyway, we thought we'd highlight the Boston Fed. And tourism. For the first round, reported that mid-November through early January, year-over-year, comparable store sales remained flat or posted a low to medium single digits. Contacts include their fiscal year of 2017. Compare store sales increased compatible, by 2.5% from 2016. In contrast, in the Commonwealth here, just a second here, it's not restaurant business reported that year-over-year restaurant sales ranged from flat to 2%. Not doing as well there in the Commonwealth. We move on very quickly here. Residential real estate heading into the end of the year. In the first district, slight to modest increase in sales there, while the Boston area data from October to October, all 6 states from 2016-2017, while the changes of single-family housing closed, sales increased in reporting areas except in Connecticut. For condos, and increased in all areas with condos, and as usual, a shortage of inventory prevented that. And that's going to be from a lot of districts. here from New York. We'll just do the general summary for New York and move on here. Summary of economic activity continued to grow at a modest pace. Manufacturing reported growth had slowed somewhat from its rapid pace during the summer, and that would probably be in many manufacturers that plan to increase capital spending substantially in 2018. Consumer spending has generally been flat. Now, that's not a very good sign. This is in New York. Housing market has been steady overall with continued weakness at the higher end of both sales and retail market. Very interesting. So that is New York, and we'll roam on here because we don't want to spend too much time on it. In Philadelphia, aggregated business activity. This is the third district, modest pace of growth there during the current period. Non-auto, retail sales, tourism, manufacturing, non-financial services grew modestly, while new home construction existing appeared to grow slightly. Little change was noted in a non-residential construction and non-residential leasing market. Most firms anticipate continual growth over the next 6 months. That is in Philadelphia. And in the 4th district, I've got to remember which one we're in here. This is Cleveland. We talked a little about Cleveland. Retailers reported higher than expected sales for the early part of the holiday season. Manufacturing output grew by a slower pace. Freight, transportation, and non-financial services saw modest to strong gains in activity. The housing and commercial real estate market remain healthy. This is very good for Cleveland. Richmond. Now, Richmond will be affected by the shutdown. Manufacturing picked up. Trucking firms continue to report robust growth compared to prior periods. Retail saw a modest increase in sales, with many stores citing better than expected holiday sales. Labor demand increased modestly, and firms have difficulty finding workers across the range. Now, this is where, in a low employment economy as we have now, there are, as they say, trade-offs between low unemployment and the labor force participation rate. Now, this is where much of this will start to have a great effect in some of these areas here, because workers simply just will not be available. Now, this is in Atlanta. This non-labor input costs increased slightly from the previous report. Contacts reported that holiday sales exceeded expectation, but auto sales are soft. Now, auto is a big part of the American manufacturing face. Hospitality sectors were positive, reflecting strong advance of bookings. Retail, real estate brokers and builders noted a mixed status there. Commercial real estate reported increase in demand. Their housing prices and inventory levels were described as flat or down. This is in Atlanta. Consumer spending, uptick in sales levels there. Modest pace there, late November and December. Expect growth to continue at that pace the next 6 months. Employment, consumer spending, manufacturing, production increased modestly. Crop and dairy farmers continue to face challenging conditions. I think we went over that before. This is from Chicago. And a lot of this from St. Louis. I think we talked about the farm sector. Unseasonably cold weather has negatively impacted the quality of winter wheat in the district. While, let's see, wage growth has been modest. Reports in consumer spending were positive. and the commercial real estate has improved. Anecdotal evidence suggests little change in employment since the previous month. Contacts continue to report difficulties experiencing qualified workers. Labor demand in Missouri was partially high in the healthcare services, leisure, hospitality, retail, and wholesale trade. Modest growth in wages since the previous report. The Contact in Louisville report increase and starting a salaries multiple times a year to attract new workers. Now, this is a little different situation. They are forced to increase the compensation there to attract new workers because it's very, very competitive in most of these districts. Yeah, let me just move along here. In Minneapolis, employment declined slightly, but labor demand remains strong. Residential construction was mixed. Energy mining activity was studied. Agriculture conditions were stable at lower levels. And in some of these states that say up to a third of their, depends on that, is on agriculture there. A transportation union in St. Paul agreed to a 3-year contract. At 2.5%. A transportation executive in Montana said wages were rising at 2 to 3%. Contacts in rural areas of the Dakotas said wage growth was more sluggish. Retailers in South Dakota reported wage increases of about 3% in the past year, while slightly lower increases expected in the coming year. And this is what's going to be very, very interesting here. How it's handled in the coming years. Normally when we have these increases, does not necessarily mean you're going to have these increases in the years to come. So in other words, in Q1 here, we've seen increases by Walmart of $1 an hour, bonuses, but the bonuses only happen as a once in a lifetime thing. Out of Kansas City, activity and employment increased modestly, and in all of these, the term is modest. Contacts in transportation, professional, and high-tech sectors noted growth in sales, while wholesale trade firms reported a slight decline in activity. Real estate activity was mixed. Banking contacts steady overall loan demand. Activity in the district energy sector increased modestly since the last survey period. Lower crop prices have continued to weigh on the district. This is out of Kansas City. So you're seeing these, the agricultural part, farm income expectations remain weak in most of the Kansas City district, but outcome for agriculture commodities was mixed. Revenue for corn, soybeans are expected to be slightly lower. We'll look at this when we report on our commodities. Lower production expectations, however, supported by modestly higher prices for winter wheat. And let's see, prices were higher than last year for cattle and hogs. It's the first time it's appeared here. And farmland values remain studied due to limited land sales. I would imagine. However, some bankers in the district expect more sales and declining value in the coming months. Interesting to note there. Out of Dallas, robust pace there. You'd expect that hiring picked up. Wages and sales prices remain elevated. The outlook improved. Although some uncertainty remains, and numerous contacts were optimistic that tax reform would provide a tailwind to business growth. We'll see. A lot of businesses have been a little bit more sluggish there. Financial services demand for loans increased over the reporting period. Commercial real estate loans also increased at an accelerated pace. Contacts also noted increasing consumer loan volumes for the first time since February of 2017. Bankers reported a notable increase in loan pricing and a tightening of credit standards and terms. Contacts expressed higher levels of optimism about overall business activity, with nearly two-thirds of the bankers expecting a stronger loan demand 6 months coming up. This is out of Dallas. Energy activity was up for 6 weeks ago, as drilling in the Permian Basal and Eagle Ford increased their T-Boone Pickens, incidentally, we were just looking at it, effectively retired from his various enterprises, including his hedge fund. We always use him in this report. Anyway, the Permian Basin and activities there. Some contracts noted increase in lending and investment. Outlook improved, but remains conservative. This is the first time the word conservative has cropped in here on energy in the Dallas range there. Agricultural harvest wrapping up. This is in 2017 with general crop conditions after a dry spell there. Texas cotton production was up noticeably from 2016 due to more acreage planted and higher yields. Cotton prices rose over the past 6 months, and contacts expect relatively strong prices to prompt a shift of more acreage from grain to cotton. Usually it's been the other way around. In San Francisco, conditions in the manufacturing sector remain solid. And what we want to look at here is in Eastern Oregon, shortage of workers in both agriculture and manufacturing sector pushed up wages substantially. Now, this is what is doing it, actually, and in the economy is the number of workers and participation rates in some of these areas. Although perhaps you've had modest gains in manufacturing, but you come from a very low standard and the workers just are not there. Rising labor costs in the district prompted some businesses to open new operations in cheaper locations. It's the first time that's cropped up. Prices, overall inflation ticked down slightly over the period. The elevated dollar continues to put downward pressure on agricultural commodities, and this is out of Northern California district and Oregon. Crops in Central California slipped. Crop yields are driven by a weak performance of certain nuts. Strong dollar continues to hold back exports. Manufacturing remains solid. Real estate robust, held back by shortage of land and labor. And this has been a problem. Land is running out. I was looking for the information technology sector. Well, sometimes you don't find everything you're looking for, actually. Retail trade prices, it's just not there. Anyway, agriculture and resource-related industries. We've already talked about the nut business there. Lending activities. The Mountain West, contacts in California typical season increases in automobile loans. Demand for deposits outpace supply, pushing up deposit rates. Interesting. That was the first time this has creeped in. Contacts noticed that liquidity was still very strong, and overall defaults remain very low. So this is basically a summary of the Beige book. We kind of took a while to get through it here, but for those that really don't want to go the other way, that's fine. In the UK, we have retail sales fell 1.5%. The reason we report this is because of Brexit and the UK economy as we've said in other reports, is much weaker than most understand it, as opposed to the rest of the Eurozone. So the UK has had some problems there with some of their basic retailers, a tough retail sale for Carpetright and some others in the UK. Inflation fell back to 3%. Winners, in course, of losers there. Carpetright, some of their internal positions. Now, main points, and this is from the UK Bureau of Statistics. In the last 3 months, the quantity bought in retail sales increased by 9/10 compared with previous 3 months, while underlying patterns remain one of growth. This is the weakest quarter of growth since the decline of 1.2 in Q1 of 2017. On the month, quality bought decreased by 1.5% when compared with strong sales in November. December 2017 quantity bought increased by 1.4 when compared with December of 2016, with positive contributions from all stores except food stores. And this is the reason we usually dive into a little bit of this. Overall, 2017's the quantity bought in retail sales increased by 1.9, the lowest annual growth since 2013. In non-seasonal adjusted terms, shopping for Christmas has shifted in recent years from being mainly in December to more in November. The same is held for in the U.S. with the Black Friday promotions. Internet sales continue to increase when compared with previous years, with the physical stores, or what we call in the U.S. a brick and mortar. Now let me just switch here to China. Now this is the official government. This is the State Council of the People's Republic of China. China's economic performance beat market expectations in 2017, but will be the bullish momentum continue into the new year. A moderation in GDP growth is a popular view, amongst global investors, given a high comparison basis with more balanced and sustainable economy is expected to take shape. The Chinese economy totaled 82.7 trillion yuan, or $13 trillion in volume in 2017, expanding at 6.9%, almost 7%, stronger than expected growth. Data may indicate a further tightening of macro prudential policy, but that does not change Japanese security trader Nomura's view of China this year. It has it's raised a 2018 GDP growth forecast by 1/10 to 6.5%, with gradual growth slow down in coming quarters. From J.P. Morgan Bank and UBC expect China's economy to expand at 6.7 to 6.4 this year, respectively. The property sector remains one of the major uncertainties facing China's growth in 2018, one of the sectors that they need to deal with. No major collapse or major loosening of property market management is in sight this year, but government policies, including support for rental housing, a faster than expected legislative program for property tax, might complicate the market. UBC China's economist Wang Tong estimates that property sales might lose momentum in 2018. They should, from our point of view, while property investments and construction growth stay robust, or soften only modestly until late this year. Meanwhile, the government's ongoing environmental protection and cleanup efforts kick into full swing, something that is needed to be done. Now, this is from 6.9. We talked about GDP here. And look, I will put this chart up. China's retail sales of economic goods grew by 10.2% year over year, reaching 36.63 trillion yuan, or $5.69 trillion, contributing as much as 58.8% of last year's economic expansion. Online spending jumped 32.2%. Mr. Marr is very happy there, reaching a record high of 7.18 trillion yuan. That was in 2017. The consumer price index rose 1.6% year over year due to a rise in food and oil prices. The nation's producer price index, PPI, went up 6.3% year over year, ending a 5-year decline. We'll put some of these on. We have quite a bit of information here, so you can refer back to it. The country's investment in real estate development grew at 7% year over year to 11 trillion yuan. That's about $1.7 trillion. Growth of fixed asset investments, much of it was government directed, edged down to 7.2%. China's industrial output expanded by 6.6% in 2017, accelerating from a 6% growth in 2016. Strong performance is largely attributed to a sharp growth of new manufacturing sectors such as industrial robots, new energy vehicles, solar power, and integrated circuits. So this information here is from the State Council of the People's Republic of China. And the Bureau of Economic Statistics will just highlight this. Agricultural production enjoyed another harvest and production animal husbandry stubbornly. The total grain output was 617.91 million tons, an increase of 1.66 there. In animal husbandry, pronounce in a minute here. We can get to it. Total output was 5.49 million tons, up 2.7%. Output of pork, beef, mutton, and poultry was 84.31 million tons, up by 0.8% over last year. While the total output for pork, staple, was 53.40 million tons, up by 0.8 there. Beef, 7.26 million tons, up by 1.3%. Mutton, up by 1.8%. Poultry, 18.79 million tons, up by 0.5%. These were 433.25 million pigs registered year over year. That was a decrease there of 0.4%. And 688.61 million pigs slaughtered on a year over year basis, 0.5 there. Growth of the total add value of industry enterprises above the designated size was 6.6%. And 0.6 there. This is industrial production. The service sector maintained a fast growth, and business activity index maintained a range of expansion there. Increased by service by 8.2% over last year, and 0.1% faster than last year. In December, the index of service production increased by 7.9%. Investment in structure continued to improve, and floor space of commercial buildings for sale decreased. Market sales witnessed steady and comparatively fast growth, and consumption upgrade showed remarkable momentum. But total retail sales of consumer goods reached 39.626.2 billion yuan, or 10.2%. Specifically, retail consumer goods by enterprise above the designated size stood at 16.61.3 billion yuan. That's up 8.1% there. The impact of imports and exports further increased, and trade structure continues to optimize. The total value of imports and exports was 27,792.1 billion yuan. That was up 14.2% there. The balance of trade was 2871.6 billion yuan in a surplus. The value of general trade increased 16.8%, for a total of 56.4% of total value of imports, exports, 1.3% of the total value of there, and let's see, of the total, the value of exports was 1,534.2 billion yuan. It was up 7.4%. Consumer prices rose mildly, and consumer prices for industrial goods shifted from decrease to increase. The consumer prices were up 6.1%, and 0.4% point slower than last year. Into some of the items here, food, tobacco, and liquor prices grew by 1.5% year over year. Vegetables, fresh vegetables were down 8.1% in December. The consumer price went up 1.8% year over year, 0.3 there. And in 2017, the producer prices for industrial products went up 6.3% compared with last year, putting into the 5-year decrease since 2012. Growth of residential income, accelerating income in rural areas, grew faster than urban areas. This is one of the things the party was addressing. The nationwide per capita disposable income for residents was 25,947 yuan, a growth of 9% over last year. Real increase of 7.3% after deducting price factor. A 1% faster than last year. The per capita income of urban households was 2.71 times that of rural households. They had a medium of nationwide disposable income. There was 7.3%. I won't bore you with these. Supply side structural reforms was further pushed forward, and transformation upgrades of new advancements. The innovation-driven development continues to gain a momentum. The number of newly registered enterprises nationwide was up 9.9%. New industries were booming. The value-added industrial strategic designed by size. The production of robots grew by 68.1% compared with last year, and new energy vehicles by 51.1%. They're really moving along with these. These economic structures continue to be optimized. In 2017, the contribution of value added of ternary industry to GDP at 58.8%, or 1.3% higher than last year. Consumption became a major driving force for economic growth. The contribution of final consumption expenditure to GDP counted for 58.8% and 26.7% higher. Green development was solidity promoted. The energy consumption per 10,000 yuan went down 3.3%. Population increased with urban roads, and the total population of mainland China was 1,390.0 million, including a population of 31 provinces, autonomous regions, and municipalities, servicemen, etc., but not including residents in Hong Kong. Of the Taiwan province, overseas Chinese, an estimate of 7.3 trillion over that in 2016. The natural growth rate was 5.32 in households in terms of gender. The male population was 711.3 million. That was 711.3 million. Female population was 678.71 million. The ratio of the population was 104.8. Female is 100. The population of working age, very important here, 16 to 59, was 901. In other words, 901.99 million. Accordingly, 64.9% of the population. Population over ages 60 and over was 244 million, which is 17.3% of the total population. Age 65 and older was 158 million, according to 11% of the population. Let me just make sure I got this right here. So we did. Anyway, the proportion of urban population to the total population was 58.52 and 1.17 percentage higher than in 2016. Generally speaking, the national economy has maintained momentum and a solid development. So these are some things. We'll append this because this is very interesting here. Let's go back to the markets. We're running a little bit short here. The BBC Global was up 16.56. The FTSE All Share 12.64. In Amsterdam 2.81. In the DAC was 153.002. In Paris 131.68. These are all on Friday unless otherwise noted. In Brussels 17.03. In Madrid 48.80. In Zurich 57.42. In Moscow in the negative 11.14. In Johannesburg also in the negative 294.82. In Bombay on Friday 251.29. In Karachi 597.95. In Lahore in the negative 45.11. In Colombo on Friday 33.39. And in Tehran on Wednesday 326, 0.60. In Sydney on Friday they were down negative 11.10. The Nikkei was at 44.69. In Hong Kong, the Hang Seng at 132.95. In Shanghai, 13.11. In New York, 53.91 on Friday. The Nasdaq, tech-laden, at 45.33. The commodities market out in the Midwest city of Chicago, the Merc, was at 12.21. And in Sao Paulo on Monday, negative 1046.11. And in Mexico on Friday, they've been in the negative range, negative 68.42. Let's go to T-Boone Pickens energy range here. Brent crude futures on Friday down 60 cents at $68.71. On the spot, they were at $58.69. West Texas intermediate crude was down 47 cents at $63.42. T-Boone Pickens is even jumping for joy in retirement. Almost 90 there. He remembers $15 a barrel oil. Gold on the Forex was on Friday was up $6.05 at $1,336.80. Dubai gold futures were up $6.30, a little bit more, at $1,334.30. Silver was down 5 cents at $17.04. Let's go back to Euronext Life futures. Corn was down 27 cents. You can see what some of these commodities are doing here. Robusta, feed wheat was also down 45 cents. Feed winter wheat futures down $1. Robusta coffee was down $18, and we can jump for joy there. Sugar, white sugar was up 30 cents. The Bloomberg Commodities Index on Wednesday, 85.59. So this will do it for us on the 21st of January 2018. Most of the beige federal districts from the beige book were in pretty good shape. But we do see some softness out, particularly in Chicago, the Kansas City market there with their farm prices. We just talked about commodity prices, I should say. And in some of these districts, basically all the districts, labor shortages are there in those areas. And finding workers, that goes back to the participation rate. And this is a problem the new administration has, not clearly understanding participation rate. The labor participation rate is going to drop, not increase, because of the number of baby boomers going out of the market. And it takes a number of years, 10 years, 5 years, sometimes more, to increase that, because again, you have younger people coming into the market. But looking at the birth rates, now we will break down the U.S. birth rates. We haven't had an opportunity to do that as we did for China, but China is in pretty good shape there. If you go to Germany, in the European sector, older populations there, it does affect productivity, especially out within 5 years. And in the U.S., you have a similar situation. You don't have the trained workers. You say, well, why did this happen? Well, the U.S. education system has been on what's so-called dumbed-down mode since the 80s under Ronald Reagan. So you had less training in the secondary or high school sector. Fewer people at that time were going to university. That has changed in the recent years under Barack Obama's administration. Easier access. But at the same time, you had a situation during the Depression that dampened those college graduates. So you had 5 years of their more or less job stagnation. So now we are literally talking 10 years out of it. The last few years there had been some pickup. So some of the more recent graduates were being absorbed into these industries, but a lot of the industries are in the so-called high-tech sector, and as seen from the San Francisco Fed, that hiring was a bit flat, and we expected that to start happening. In fact, the nature of information technology means that you will have a few workers in that section, although there would be some expansion. There would be other areas in China with robotics. The U.S., China is far ahead of the U.S. in robotics. What effect that will have on the work structure, and also in terms of algorithmic work. The algorithms are there, and machine learning, but machine learning is coming into play. We talked earlier here, and you can now get this broadcast today on Echo, Sonar, and various other of these voice-activated speakers. You're going to see more and more of that coming in as to how you get your information. Now, because of the shutdown, we will not have up-to-date depending on how long. Now, remember, this is just into the first week, but you're really looking at 2 weeks. It takes about another week to bring many of these agencies up to where they were. And then you have volumes of work that is piling up. So in other words, we gave you some of the older statistics, and we will append. We'll have a lot of appendages here. The 2013 results, 2013. That was basically a 2 weeks affair, and its effect on the economy in 2013. But now remember, this economy is a little bit different in the sense, first of all, the rate of redundancies or unemployment are lower. But what the meaning is there, that there are fewer workers left. In other words, you had more slack in 2013, 2014. That slack is starting to wind down. There's still some slack out there, as some political activists have pointed out. Now remember, the unemployment figures only come from people that have been in the system. Now, if you have not been in the system for the last say 6 months, you're no longer in that statistic. So you do have the so-called real number. Now, you don't hear very much about that now. You were hearing lots of it from this administration earlier. What the real number of people that are unemployed out there. You always add a few percentage points to that. But even with that number, and with the participation rate around 62%, you have shortages. And what those shortages are beginning to do, even at this rate, is constrain business development in some areas by as much as, say, 10%. So we'll see how that bodes out. Effectively, that will start to cause some problems. And in the construction industry, land is a factor there. There's only so much land out there that can be developed on. And also we have uneven settlements there. We have some of the more productive, at least salary-wise, of workers in the high-tech sector and urban middle-class workers, I should say, moving into urban centers, whereas there's a shortage of housing in the urban centers, particularly affordable housing. And then you have the suburban extraburg situations like the housing problems out in Washington State, that the medium house in Seattle, particularly downtown Seattle, is at about $1 million. And you have a huge homeless problem there, so the social costs. And that is because of how things were settled. They were not planned very well at all. And you go from city to city. Some people brought back reports of what was going on in, say, New Orleans. This is after Katrina. and after some new developments like casinos, etc., that were not there before Katrina, but you still have a large homeless problem. And, of course, looking at that also as a hub where people are coming in, Atlanta also. So all of these so-called urban centers still have these large homeless problems. They have shortages of affordable housing, and that is affordable housing for people that work full-time, say making $30,000 a year, $40,000, $50,000. Police officers can't live in San Francisco because they can't afford it, nor can teachers. So in other words, we're having these very uneven development, and this is something China has started to address. Now, as far as our environmental problems, it wasn't mentioned in the Beige reports, but because of some of the drilling, what I call casual drilling, it's not needed in various areas, opening up of natural lands, offshore, etc., that we'll look at these energy prices to see where they are. Now, remember, OPEC has a production limit on. As long as OPEC and some of the others keep those quotas, energy prices will be higher, but also will translate out to higher petrol or gasoline prices, which will impact consumers that borrowed to have this robust holiday season we talked about from the Beige book. So all of these are impacting in here. So next week, hopefully we'll start to get some results, some more hard facts in from the shutdown, whether the shutdown is over or not over. The market has not really caught up with it yet, because shutdowns are a little bit murky in the sense that we've had several of them in recent years. In the 90s, we had the longest one, but in 2013, we had another. We've also had state shutdowns that have happened, and what happens there is more with firms that are doing business with the government, and in areas like Virginia, Maryland, those areas where workers are furloughed. We'll start to see the impacts there, and especially in consumer spending, and we don't know how well prepared these workers were, and whether or not even the workers will be paid for time off. This will do it for us. We'll see you next week. We'll have, incidentally, this week coming up, special reports from the World Economic Forum that we've been covering at least the last 10 years or more, and the affairs in Davos, perhaps minus the Trump administration. They may literally not get off the ground. But we will have those, and we'll start having those. So look on our financial channels on YouTube, etc., where Numbers Man appear on iHeart, and we'll bring those to you as timely as possible, on which world speakers speak there, and some of the ins and outs of the World Economic Forum. Good day.